All right, hello, She's on the Moneyers. So we are joined today by Rebecca Tunstall from Rathbone. And for those who weren't able to make our Girls Just Want to Have Fun event, we are doing part 2 in a couple of weeks in January. However, we wanted to give you the opportunity to hear what we did in part 1 because it was really interesting and gave you really good foundations for getting started with all this investing stuff. So hi, Rebecca.
Hello.
I'm back for more. So, as we said in the first event, there's so much I find there's so much confusion when it comes to investing stuff. It's like ETF funds, robo advisors, index funds, stock shares, and then some of these things are even the same thing. And I'm just like, oh my God, where do we start? So, Rebecca, before we get started with all demystifying all this investment stuff, do you want to tell us a little bit about yourself?
So I'm Rebecca. I've worked for Rathbones for almost 9 years now, but I've been doing this for over 15 years. But I am really passionate about making sure that women understand their money. And one of the really important okay, you might have to cut that, but there are many reasons that it's really important that women understand their money. And so here we go. Let's start. Why women need to invest?
Woo.
Well, first of all, we are a more important demographic than men. We live longer than men. 7 in 10 people aged over 90 are actually women. But actually, we have much more pensions than men because we take time out of work to have children. We actually might take time out of work to take care of our elderly parents as well. And we also end up spending quite a lot more money on childcare. So there are quite a lot of penalties that come against women, even though we live longer. And on top of that, we're actually much more conservative investors than men. So on every front, women are penalised, which is why it's so important that we have a good foundation, a good knowledge of what our aspirations are and how we're going to achieve those. Gonna let you do that.
Yeah.
So let's consider, what are we trying to achieve in our lives? Well, a lot of us actually want to buy a house, or maybe we want to upgrade the home that we already have. We want to pay for our children's education, and obviously we need to pay to bring them up, quite expensive. And then ultimately, we want to be able to finance our retirement. So how are we going to go about doing that? Well, let's have a look at how much a child might cost to actually raise. This is a per child cost. If your kid goes to state school, it's about £220,000. This is the lifetime. If your child goes to a private school, it's just under 400,000. And if your child goes to a boarding school, it's just under £500,000 per child. Astronomical.
Why does anyone have children then?
I don't know.
Wow, okay.
They're delightful, really. Worth every penny. And again, we might want a house. Now, housing in the time of our parents is very different from housing now. Houses cost a lot of money. It depends where you want to live as well. And then finally, when you come to living in your retirement, you probably don't want to live on 10 grand a year.
No.
You spent your entire lifetime working, you probably want to be able to afford some nice things. So if we look here, this is just an average cost of a couple living a general year in their retirement. That works out at maybe £45,000. Maybe you want to sit down and have a think about how much it might cost you. What do you want to do?
And I believe the government says if you do not want to be uncomfortable at retirement, which is not saying it's rich, it's saying if you don't want to be uncomfortable, you've got to have a minimum 250,000.
But bear in mind that is a UK average. We live in London, which is going to be an awful lot more expensive than the UK average. But yes.
And I don't want to live on beans and toast.
No. You might want a cruise or two.
I want a cruise.
So just let's start by thinking about that £45,000. Your calculation might be a little bit more, might be a little bit less. But say we want to have a return of around 6% per annum for our retirement pot. What might that look like as a final sum that we would need in our retirement? It works out at about £750,000. Oh, it's a lot of money.
That is a lot of money.
So if we then look at the 3 things that we spoke about, we've spoken about our children, we've spoken about our house, and we've spoken about our pension. If we put that all together, say we need £750,000 for our pension, and we need a house, let's say it's around £800,000. I'm presuming that we live in London, so that works out about average. and our child's education. We're saying that we've got one child who might be going to a private school for the basis of this.
Yeah.
So that's £2 million. That's a lot of money.
That is a lot of money.
But don't panic. We have a long time to go. And the race is long, and it is all possible.
Okay, good.
Tune in next time.
Tune in. Okay, guys. So now it is time to go get your coffee. Don't fall off your seat. It's all right, because we're going to find out how it's all possible in the next part. Okay, guys. So we are back for part 2 of this presentation. So we're still joined by Rebecca Tunstall, and she's just told us that we need £2 million at retirement.
I'm here to depress.
So maybe we'll put this video out after Christmas. But so Rebecca, so guys, this is part 2 of Girls Just Want to Have Fun. So how are we going to make this work?
How are we going to make the dream work?
How are we going to make the dream work? Please tell us it's good news.
So when we look at the money that we need, there are 3 different ways that we can go about saving our money. So first of all, these are the 3 ways. So first of all, you can stick your money under the mattress. There are lots of reasons why this might not be the best idea, not least because someone might rob you.
House might burn down.
House might burn down. But you're ultimately hit by inflation. There is no growth for sticking your money under the mattress.
So just quickly, for those who don't know, inflation is we're already
we're gonna come to that. But
don't
worry,
I'm too keen.
Super keen.
I'm too excited.
So guess if I had £2 million today, just say I'd won the lottery, for instance. If I had £2 million today, what do you think inflation would do to that by the time I retire? It's a very good question.
If you kept it in cash.
Yeah, this is my under the mattress option.
Do I have to answer this question? I'm like, I didn't know if that was an actual question to me. I'm not sure. What will we do?
Say that we had 45 years before we retired. We'll all be different ages. We'll all have different time horizons. But just presume, for the sake of this, there's 45 years to go. Okay. So if we assume inflation is 2%, that's the government target. Okay. It would mean that our £2 million today that we received would actually only be worth £800,000 in 45 years' time. Oh. So what that means is I might be able to buy a house for £2 million today, but in 45 years' time, I'd only be able to buy the equivalent house for 800,000. So I'm losing money. Yeah. But 2% actually is quite low for inflation. So assume it's 5%. That means that my £2 million is actually only worth £200,000. And in the 1970s, inflation was running at 15%. Our £2 million under our mattress in 45 years' time would be worth £3,500. So I think we've all decided we're not leaving it under the mattress.
Don't leave it under the mattress. Got that.
Okay. So our next option is to put it in the bank. Okay. And I know lots of people have money that sits in the bank. Yes. So let's have a look at what that means. So say we had £2 million, again, someone's been very kind and gifted us £2 million. Say we're earning about 1% in the bank. You might be earning a little bit more than that at the moment, but not much. So say on my £2 million, that's my £20,000 worth of interest. Great. I look like I'm making money. Yeah. However, I've got tax because I'm going to be earning some money, and so I'm going to be paying some tax on that. Let's say that's at 40%. We're presuming we're earning a reasonable amount of money. So that's £7,600 in tax. But wait, inflation. So we've spoken about 2% being the government target. We're going to presume that it's 2% for this. And you can see at the end of the first year, this is just 1 year, we've actually only got 1,970,000. And that's per year. So you can see that inflation is not your friend. And keeping money in the bank, even if it's earning interest, you can be losing money every single year.
I feel like inflation needs more airtime. This is not a good thing.
It's really not. People don't seem to understand it. I can't tell you how many people have cash in the bank and don't understand that it's losing the money every single day as they sleep. So that comes us on to our third option, which is investing our money. So equities, and we'll talk a little bit about what those mean in our part 2 session, but they have over time historically given us a return of 5.1%. Now remember, we spoke about inflation being around 2%, which means that we are making money every year. we're getting a return that's greater than inflation. So if we look at our £2 million at retirement, what do you think that we need to invest today to get us our £2 million based on the return that we've just spoken about?
Oh, it probably wouldn't have to be as much as we think it is.
Exactly. All we need is £200,000. It's still a lot of money, but it's a lot less than 2 million.
It's a lot less than 2 million.
So do we feel a bit more comfortable now?
We do. But is that like, so when you say that if we go back one, is that saying that historical average of the 5.1, that's what is literally in history that has shown us?
So that covers big market upswings, but it also covers big market downswings.
Okay, because I know that's a question for people. They're like, but is that,
Yeah.
Okay, so that's an average.
And we'll come on to talk about risk, and it really depends on the level of risk that you take, but that is just a historical average of what equities by themselves have returned you over a long period of time. Okay. But how can that be possible? Albert Einstein, close personal friend of mine, wrote that the most powerful force in the universe is compound interest.
We love compound interest.
Who doesn't
Compound
love
interest
compound
is our
interest?
friend. Inflation, not so much. Compound interest, get
big
on
friend.
in.
I know, opposite ends of that spectrum,
Yeah.
right? So what is compound interest? Compound interest is basically reinvesting your money to make it work harder for you. So say you invest £100 today, and over the next 100 years, that would become £1.3 million, were you assuming a 10% growth rate, which is quite high, but it makes it nice and round for my numbers here. But what we're effectively saying is if I have £100 today, and I make 10% on that, I have £110 at the end of year one. I put that £110 back in, and I get a 10%, and then I get £121. And that just keeps going, and it keeps working for you.
So ultimately, you're earning interest on your interest.
Exactly. Which is why we always talk to people and we always encourage people to start saving young. And it is so easy to say, oh, well, it's only a little bit of money. I'll start that tomorrow. I don't feel very rich today. I'm just going to start that tomorrow. But even if you start with £10 a month, it all adds up over time. So what you can see here is we have Alice, who's 25 when she started saving, and Sophia, who was 35 when she started saving. By the age of 65, Alice has twice as much as Sophia. That is how powerful this is, even though there's only 10 years between when they started. Twice the amount.
Incredible. All right, guys, 2019 is going to be the year
of saving. Okay.
And she would never be able to catch up, would she, because of the compounding interest?
Never be able to catch up. She'd have to put in twice the amount.
Crazy. I don't know how we're not talking about this more and shouting it from the rooftops. Compound interest. Compounding interest.
So, but that's exactly right. Why don't people talk about it, and why don't people know to save their money? So you guys, you might have some cash in the bank. Molly, do you have any cash in the bank? You have some cash in the bank. Molly, what are you doing? What are your options? Let's talk about what Molly should be doing. So first of all, your most basic saving option is your bank deposit. We will all have some cash in the bank, and it's important that you don't invest everything that you have, because what happens if the boiler blows up, or your car needs fixing? So always keep some money in the bank. And I know that we've talked about it losing you money, but you don't want to lock it up in investment. So some of it in the bank deposit is perfectly sensible, and we normally say about 6 months of spending. But then you have ISAs and pensions. These are both genius tools for long-term savings. I can't remember what my name.
And there's like quite a few different types of ISAs, aren't there?
There are lots of different types of ISAs, and everyone should start saving into a pension. And what we're going to do now is just run through the pros and cons of ISAs and pensions. So first of all, we talked about your bank account, easy access, very, very low risk. But like we said, it has very limited returns. There's a limited amount of security. And what we mean by that is if the bank that you have your money in goes bust, they will only guarantee up to £85,000 worth. Might not be a problem for anyone. moment, but just good to
One
know.
day it will
Yeah,
be.
yeah,
I'm
it
sure.
might. And sometimes there are some penalties. So if you put it away and you say, listen, it's a 6-month deposit, and you decide you need your money back, they will charge you for that.
Okay, so sorry, just go back to that one point. So if my bank goes bust, which is extremely unlikely, but
Yeah.
you only actually get 85.
Yeah, so you're guaranteed up to 85,000. Now that's per bank.
Okay.
So some people spread their money into different banks. I mean the admin, but you can do that. So our next best option are ISAs. We love ISAs. The tax man gives you very, very few tax breaks. ISAs are absolutely brilliant. Firstly, they're easy access. You can go to Money Supermarket and just Google it.
And that's an individual savings account.
So ISAs come in 2 different forms. You've got your stocks and shares ISAs and your cash ISAs. I think we've discussed why we probably wouldn't leave it in cash.
Yes, and in the first episode, we also spoke about how women like to keep it in cash because it's kind of secure. They know it's there.
Yep. Women are very low risk investors, which actually is a huge negative to us because if you think we live longer, we're not going to get the same amount of returns if we're very low risk investors. And we'll come on to talk a little bit more about that in a minute. But ISAs are completely tax free. So there's no capital gains tax, there's no income tax. If you die, they are liable to inheritance tax. Okay. But in your lifetime, you pay no capital gains tax, no income tax on them, which is absolutely brilliant. So the money just sits there, grows, and you pay no tax on it.
So quick question on that. So if I have a stocks and shares ISA and I get my allowance every year and I'm just putting that in every year into my stocks and shares, I'm not having to pay any tax on it?
No tax on it after you saved it. But it raises a really good point. You only get an allowance every year. So this year and next year it's £20,000, and you can't put any more than that £20,000 in there because it's tax free. The government say that there's a limit.
I think for many of our people, that's probably what they're going to be.
I mean, I don't use my whole ISA allowance. Most people don't, but it's just useful to know.
Okay, great.
And then finally, you have your pensions. Now, once your money's put into your pension, you can't take it out again until you're 65. And 55. No, sorry, 55. I imagine that age will go up.
It will go up.
There are limits to the amount of contributions you can put in, depending on how much you're earning. So if you're not earning anything, the limit is very low, and it rises as you earn more.
If you're working full time, do you know what the limit is around?
It really depends how much you're earning.
Okay.
So it goes up until you're earning a certain amount of money, and once you become somebody who's earning a lot of money, it starts to go back down again. And it's to limit the amount that people can put into, because again, it's really tax efficient. You pay no tax on it at all, and it's also inheritance tax free, so you can pass it to your descendants without paying any inheritance tax on it. So again, it's a really useful savings tool.
And I think we use this a lot in our podcast as well. If you're quite close to a tax bracket, you can put more into your pension.
Exactly. £100,000 earning tends to be quite a significant sort of tax change, and so a lot of people try and stay below that barrier by adding extra to their pension. Just beware, you can't access it until you're much older. You can take a tax-free lump sum at that stage, and actually these days pensions are very flexible. But you need to be comfortable with what you're putting in there, because you cannot get it back if you change your mind. ISAs you can withdraw money, pensions you can't. So when we're looking at what we want, we've got our pensions, we've got our ISAs, and we've decided that we want to invest those.
We do. We don't want to leave it under the mattress. We don't want to leave it in cash.
How are we going to go about doing that? Well, I think we would all love to take absolutely no risk and make loads of money. Wouldn't that be amazing?
50%. I want to double my money
in 1 year and take no risk at all.
I do hear people say that though. I think people have that. They're like, I'm going to invest. I'm going to I want to double my money. And I'm like, I don't know if that's realistic. Realistic investing.
How long do you plan to do that for? So that's really what we want. It's not realistic though. I think we can all accept that in order to make money, we have to take some risk. So you can see here, the more risk we're willing to take, the more money we can make, the higher returns that we should expect. This comes back to your point about women being much lower risk investors. We will make less money on our investments because we're not comfortable with taking so much risk. And I think we're not comfortable taking so much risk because we don't understand what we're doing.
We're not confident, and
Exactly
right.
So hopefully this helps with that.
Yeah. And also, I think women like to be experts at something before we actually do it. And so unless we know everything about it, we don't want to invest. But I think with this thing is, we've got to get we can get the basics, and then there's avenues out there that.
And I always think, and I spend a lot of time talking to female clients about this, you don't need to put everything to work right away. Start with something small, something that you feel comfortable with, and then build from there. You don't have to say, I'm going to put everything in equities tomorrow. That's really not what we're talking about here. It's about working out where we want to be in the end and finding out a way to get there.
Having a plan.
But don't push yourself to a stage where you're feeling uncomfortable. It's a long-term goal. We're talking about 45 years. You don't need to go, it's not go home or go broke.
No.
Is that even an analogy?
It works.
It works. Great. So what we're saying here is we're actually looking at, I've said that equities give you 5% over the longer term, but is that really true? Who knows, right? I could be saying anything. So what we've got here is a graph that really shows the difference that you can get on very low risk investments and things that are higher risk. And when I say higher risk, I'm talking about equities. Do you know what an equity is?
I wouldn't mind you breaking it down for me again.
So an equity is effectively a stock that's traded. And what I mean by that is Apple, Amazon, all our companies we're really comfortable with, they are listed on markets. Those are stocks and shares that people can actually buy and sell. So I might think, the next iPhone is going to be amazing. I think that I want to take part in that. I think Apple's going to do really well this year. So I'm going to buy some shares in Apple, and then I own a little bit of the company, and I'm going to see how well they do. So if we had bought Apple shares when they'd floated in 1980, they will have returned us 50,000%. That is how much money you would have made. Now, I'm not saying that we put everything into Apple. That's definitely what I classify very high risk, but it just gives you an example of the kind of returns that you can see from equities. This graph, at the bottom, it says gilts and T-bills. Those are basically government bonds. And again, in part 2, we will talk about exactly what those things mean. T-bills are American government bonds. Gilts are British government bonds. And equities are, this one particularly we're talking about is Apple, for instance. But you can see that you make a lot more investing in equities.
So on the FTSE 100, are they all equities?
Those are all equities.
Hey.
Those are the 100 largest companies in the UK.
And then America has their version, Australia has their version.
So the S&P 500 is the biggest one in America, and that's the 500 biggest company in America. Okay, so why would we want to invest in a company? I think
why wouldn't we want to invest in a company?
So when you invest in a company, so say my Apple, there are 2 different ways that I can make money investing in a company. One is just because Apple's a good company, it might go up. So I will make some capital return. But you know that interest that you get on your bank account? Companies do the same thing. So what companies do is they will give you a dividend. It's exactly the same as the interest. And it's a sort of thank you for investing in them. So they often give you a dividend.
And do all companies do it, or just some of them?
Gosh, good question. Only some companies will give you a dividend. It really depends on the type of company. If it's a small startup that's growing really fast, they probably don't have spare cash. They can't give you any dividends. They can't give you a thank you for holding their shares because they don't have the extra cash to do it. But if you're thinking of something that basically owns a gas station or an electric plant, for instance, they're probably making a lot of cash. But what are they going to spend it on? They might not have a huge amount to spend it on. So what they might say is, actually, I'm going to reward the people that are holding part of my company instead, because I'm not growing really fast. Okay. Does that make sense?
Yeah. And then, so I guess, how do you tell which companies have the thing, which don't? Does it say on their website, or does it say when?
Yeah. So when you're looking at a company, it depends how you're looking at it. If you go on, if you Google a company, for instance, it will come up with a company page on the side. It will give you how much it's trading for, etc. And if you go into that part, the company part on Google, it will tell you, and it will call it a dividend yield. They don't necessarily use income, they call it a dividend yield, and it's done as a percentage.
And
so
you get
it
that
might be
every
1
year.
or 2, exactly, based on the price at that time.
So that will be almost like a income that just constantly happens.
Yeah, so that's your income. And then you hopefully will make some capital growth as well. So that's how you that's what consists, that's the return that you might get from a company.
I'm lacking this investing stuff. Gold.
So when we look at investing, not all things are equal. No. Some things are higher risk, some things are lower risk, and some things are there to act differently. This is what we use at Rathbones. Every company will have something different. And effectively what we're saying here is some things are very, very low risk. And we call those liquidity. Those are things that you can take money out of tomorrow. So those might be cash, but the government bonds that we spoke about as well. And then some very high quality investment grade bonds. And what I mean by that is like Tesco's or a really good quality company that might have some bonds. And again, in part 2, we'll come to explain exactly what those mean. And I understand that it might sound a bit technical, but it's really very simple.
Will we also cover government bonds?
Yeah, we will go through all of it.
Cool.
And then we have equities. And if you think about it like a car, your liquidity is very much there as the airbag. It's there to stop any big ups and downs in your portfolio, in the money that you have. The equity, that's your engine. That's there to drive your growth. And that might be in the UK, that might be overseas. It's a huge mixture, but those are the things that are going to be going up and down the most, but they're the engine driving that growth that we spoke about. And then you have diversifiers. And if you think about your car again, those are very much your suspension. They're there to stop the big ups and downs and to make them slightly smaller. And those are things that are designed to act differently to equities, or at least have shown in the past that they don't act the same way as equities. So that might be infrastructure or bricks and mortar property, things like that. So, question, Molly. If I was going to have something that was very low risk, do you think that we'd have more or less in the equity?
Less.
Great.
I'm glad I got that right. We'll edit it
Sorry,
out.
I didn't mean to put you on the spot.
No, that's good. So when we put something together, we want everything, or a little bit of everything.
So what we're looking for really is a little bit of everything. And again, it really depends on what we're trying to achieve. So if we go to this, again, this is something that we use at Rathbones. Different companies will use different approaches, but effectively what we're saying here is there are lots of things that drive the amount of risk that we're going to take when we invest our money. Your time horizon, how long do you want to invest for?
Well, till
you retire, maybe.
Till I retire.
So you've got a really long time horizon. So when you think of it like that, you could take more equity risk. You might not be comfortable with that. We'll come on to that. But you could really, if you've got a long way to go. Say I wanted to buy a house in 3 years. Well, actually, I can't take the same kind of risk because I'm going to need that money back pretty soon. And it's not to say that you don't have different pots. You might say, actually, I have my 3-year pot because I do want to buy that house. So I'm going to invest that very cautiously. But then I have my long-term pot because actually, I want to retire and have my £45,000 worth of income. So I have different pots which are doing different things. So we've got our time horizon. But are we comfortable? And everything that we do is about, can you sleep at night? So what we have here, when we go down, if you look at nearer the bottom, it says risk measure maximum drawdown. What maximum drawdown is, and this is taken over a 24-year period, is the difference between the top and the bottom in that time period. It's not to say that we buy at the top and we sell at the bottom. It's just to give you a measure, the ups and downs that you might see in a mix of assets like this. So we said that maybe with your pension, you might be able to be quite high risk. But the maximum drawdown, so the difference between the top and the bottom, is 44%. Not so comfortable.
No.
So everything that we do is about thinking about where are we comfortable.
Okay.
So you might be able to take that risk, but are you comfortable taking that risk? Will you be able to sleep at night? And you can see here the absolute least risky option is 10%.
And is that just completely personal choice, like what you want this kind of appetite to be?
It is and it isn't. Because if we look at number 1 and number 2 here, what we're saying is I want to preserve the value of my money. Rebecca, I've made my £2 million. I know that's all I'm ever going to need. So I just want to keep that £2 million. I don't need it to grow. I just want to keep it. Okay, so it's a capital preservation. I want to keep the money I've made. Okay. And once we get to number 3, we're saying, Rebecca, I want to maintain the spending power of my money and then maybe grow it. So what I mean by that is I want to be able to buy my hamburger today, and I want to be able to buy the same hamburger in 10 years' time. Or I want to be able to buy my Ferrari today, whatever floats your boat, and again in 10 years' time. Okay, so I'm keeping up with that inflation that we spoke about, and then hopefully making some extra money. So although you might say to me, on paper, actually, I really only want a drawdown of 10%, can you reach your goals doing that? Because you have to understand the risk and reward. So for a lot of people, they do take a little bit more risk because they know that part of their pot needs to be growing for them in the future. Understanding that they probably need to just knock it up and not look at it for 5 years. And
then so with this lower one, so does that still mean that it's not going to be affected by inflation as much?
So no, that is the thing. So number 1 and 2 will be affected by inflation, and that's the problem. So you will still have your £2 million, but what you can buy for that £2 million in 5 years' time is going to be a lot less than what you can buy for it on the day that you give it to me. But I've made my £2 million and I want to hold on to it. So that's really what number 1 and 2 are. And so it really depends on what you want to do and how you want to go about doing it. Now, I think what we've talked about here are, we've run through what your long-term plans might be and how we're going to achieve those. Understanding that actually we only need to start with our 200,000 to get to our 2 million in the end. And the ways that we're going to start doing that is our ISAs and our pensions. Do you want to do that?
So this was more just about, so this is like, I technically took this off Google, and it's a FTSE 100. So I'm just looking at this now and I can see we're in a bit of a downhill trend. So does that mean that like maybe it's a good time to start getting involved in the share market, or do you wait a little bit longer until it completely comes down, or do you just stay with a plan and you have a plan, because no matter what happens, as we've talked about, over like 40-year time period, it's not going to be a bad thing. And obviously this is education, not advice. So caveat.
From an educational perspective, it raises a really interesting point. Some people, when markets go down like this, they get very scared and they actually say, I want to go into cash. Whereas some people actually look at this and they say, well, it's an opportunity because I could have bought the FTSE 100 at 7,600, but actually today I can get it for 6,700. So I'm actually getting a much better price for the money that I put in. So actually maybe that's an opportunity. Again, everyone is different, but when you're looking at it over a 40-year period, arguably it doesn't matter. And the other beauty is that if you're investing, and again, I'm not suggesting that you should put all of your money into the FTSE 100, because what we're saying there is that we're all equity. So that's the highest risk we can be. But if we're putting in £50 a month into a savings that looks something like the 3 or 4 that we talked about a moment ago, each month we'll buy it at a slightly different price. And over time, that will average out. Sometimes it'll be higher, sometimes it'll be lower. So if you've got a long time horizon, it doesn't necessarily matter.
And a really quick question, because I know we're running out of time, but this is a question I always get asked. If you're in debt, bad debt, credit card debt, should you be investing?
Always pay off your debt first. The interest that you're paying on your debt is a lot higher than anything you will ever achieve investing. Always pay off your debt first. The caveat to that is mortgages, because often you get a very good rate for those. But anything like credit card debt, store debts, get rid of that before you consider saving anything.
There you go, ladies.
And if you want to know about how, there we go. Look, types of investments, the only thing we haven't covered. So we've decided we want to be 1, 2, 6, wherever we think that we feel comfortable. How do we go about actually investing? So here are some great networks that you can use. You can use Nutmeg. You crack on.
We've got Nutmeg, Wealthify, Moneybox, Wealthsimple. And so what a lot of these companies do is they have an app on a phone. You pick your risk appetite, so how risky you want to be, and then it invests your money for you. So it's a really great way that you can actually, if you want to try this whole investing thing out, which I think if we've learned anything today is yes,
we should.
These are just some really great ways to get online and be a part of it really quickly. And they're really simple to use. And also there'll be a couple of these guys. So Wealthsimple and Nutmeg will also be coming to our next event and actually demoing and showing us how to use their apps, which is great. So guys, in part 2, we're going to be covering these things: bonds, managed funds, investment trust, ETFs, but in a lot more detail. So Rebecca's going to take a bit more of a deeper dive. So if you can make that, we definitely do try and come to Girls Just Want to Have Fun's part 2. It's going to be here at Rathbone on the 29th. And if you can't make that, maybe we can do something again similar in the new year for all those who missed it. But thank you so much, Rebecca. I know I am going to be getting my cash ISA and turning it into a stocks and shares ISA very soon. All right, girls. And as we say every time, go on and be financially fearless. Have a great Christmas, and we will see you in the new year.